Good evening. This is Ken at Tortoise Capital with a review of the weekend trading plan for June 15th, 2019. So we're back into bullish normal conditions. We're overbought on an annual and a 10-day basis. The strength of trend is up, green neutral at 18.4. The risk index is the 30-period moving average of the VIX divided by the 10. It's scoring at 1.054 right now, which puts us into risk on because it's above that threshold value of 1. Take that score, compare it to the last 5,000 trading days to compute the risk Z, which is at 0.5. And that means we're half a standard deviation above the long-term average. Here's a 90-day histogram of that indicator. We've come out of a 2 sigma adverse move. This has been a great swing move. The swing started when it got to minus 2Z and then started to uptick, and then this favored swing trading, as you've seen, as we go from the spring into the summer of volatility. Still more room to go, but the first leg or two has already been built in. So swing trading on the long side is still favored right now. We'll see when we look at the health check that there's room to go back to the swing high. You can see the blended monthly rebalancing holdings right now, which are balancing the safety of treasuries with the growth potential of technology and some consumer staples. So that seems like a reasonable mix. These are the leading contenders based on the closing prices on Friday. Still treasuries and the technology mix. Theoretical exposure of ETF2 is at 50% with half of the world's indices above their 4-month moving average. So in terms of asset allocation, this is a cautiously optimistic market. Quick look at some blended monthly rebalancing portfolios. Treasuries, technology in the U.S. Are strong. Basically, the emerging markets, Latin America, small caps, and Asia, Japan are weak. ETF 32, it's the same picture. About 2/3 are on a buy signal, 1/3 on cash. Weakness in the area of China, commodities, emerging markets, Latin America. Strength in some defensive plays like treasuries and consumer discretionary, but technology definitely leading the way. Materials have made a nice rebound this week too. Sector spiders, same, about half and half long versus cash. Aerospace, home builders, insurance, treasuries, discretionary. So XLY is certainly on the radar. XLY discretionary and XLP consumer staples. ETF Max. This is the top 40 or so out of the 500 ETF database. Aerospace, home builders, insurance, corn, treasuries. Excuse me. Market health check. A mix between above and below average here in the U.S. with basically the large caps and the growth side dominating. Small caps are lagging. Latin American emerging markets under average. Canada and Mexico, and I think that's probably with the commodities as well, doing well. In the business sectors, it's materials, tech, staples, and consumer discretionary. The ETF2 lens gives us the same picture. Home builders, discretionary at the top here, treasuries, technology, and staples. So I think that's the signals are pretty clear. Every lens we're looking at is showing the same issues. Looking at the daily report, market health check. So this is that nice rebound after the sell-off. This has been a very nice rebound leg one. I like that it's stabilized here north of the dragon, but I am concerned about this topping action that was indicated around Tuesday. It still has to get above about 292. Then we have a chance to retest this swing high at 294. But I'm using the rising dragon as sort of that buffer. If that fails, then it's down to the long-term fair value and the 200-day moving average down here around 279. So there is some tactical play, not to be in a hurry. would be the key. And really, it's got to get above this 296 to really be decisive. In the MACD histogram, we had that long slide from fall into winter. The spring move, once again, is the move. And now we've just confirmed the gains here with the summer. And the fact that we have had failure to fail further plus the summer, that's the case for the upside optimism. But again, we get about $5 a tactical play before it gets to be operationally significant. No signals in channeling or reaction. Some of the key technology plays are on a max pain, so Intel, Cisco, United Technology. So I would actually be looking at those as reasonable ways to start playing a rebound. So if we get market up and tech up, then these 10-day max pains have the most recovery to do. So I would be looking at some nice plays possible in there, Cisco as well. Inside the ETFs, that's going to be Brazil and South Africa come to mind there, and then there's some room here in the energy with oil and oil exploration. In the Dow Tactical Summary, a handful of dojis. There's only 3 that auto frame out well because we're actually getting back close to the 10-day highs. That's what makes that problematic. Only United Tech is really attractive among the top 5. But that's one that we'll definitely frame. In the ETF Tactical Summary, again, half a dozen or so dojis, more auto framers testing out well. Energy sector was at a big one-day bounce on Friday. Treasury still flight to quality protection over the weekend. And U.S. real estate having a breakout, as did XLY consumer discretionary. That one, XLY XLP, look like short list attractive to me. Standard plays in the auto framer. I'm liking United Technology at the top of the list here with 5.5 to 1 reward to risk ratio. Even technology though, XLK with a 2 to 1 reward to risk. In the regression line fractal framework, these are some swing trade patterns that look promising. In the top shelf in the green, the symbols that are the most average 2 ranges below their RL270. These are the deeply discounted value plays, so like still Boeing, 3M, Intel, United Tech. In the ETF 100, natural gas, China, oil exploration in Brazil, all things that look like there's some value baked into the cake. The bottom shelf in the red, these are the symbols that are the most ATRs above their own 270, so these are the more advanced relative strength leaders. So the way we read that, General Electric is 7.5 ATRs above its long-term fair value, so that's part of that recovery that it's experienced. Home Depot's just been brilliant, almost 5 ATRs above its long-term fair value. We'll see that one in the when we review the weekend swing trade patterns. Daily squeezes, a lot to choose from. There wasn't much volatility Thursday or Friday, so these are squeezed. And then the breakouts, one-day breakout opportunities. I like the fact that the S&P is a coiled spring here with a 2.5 to 1 ratio. If it just breaks out above its high and then does an average range move, and you use the Friday's range as your trailing stop, you still have a 2 to 1, 2.5 to 1 reward to risk ratio. So that looks really attractive. I like that DIA is on there as well as a small cap. So these are all indexes that are in critical states, poised to break out in either direction, but the upside is really attractive. You can see again, failure to fail further. The regression line has reversed. The polynomial one has already hooked up. The 30 linear has already crossed its 10-day and now is back to the long-term fair value. It's come, or long-term average, I should say. You see that here in the slope. So this is really kind of a critical state. This is where you would expect it to either make that next leg up to maybe towards 300, or to find on a declining slope. This is where a logical place to roll over. So this is actually a very critical state, an argument for a strong move in either direction. So I'm going to be beginning this week with the idea of building positions intraday and then letting the price direction pull me long or short based on how it's moving. You can see the RL90 has the overheatedness has come back into the middle of the river. So this little cooling off period has now allowed us to process the joy of all those gains, and it's at a logical support level where it found support where it used to find resistance before. So it's had one nice bounce, and now we're going to see if it can power on through, make some all-time new highs. Or is it going to come back here to 275 at the bottom of the river? So market in a critical state, waiting for some direction. And that's everything we want to cover from the tactical play. Again, keep your risk measured and powder dry. This is really more like a stock pickers and short-term momentum, and bird in the hand is worth two in the bush. This is one where we want to make bank intraday, and with short-term swings, I am much more inclined to take the wins when I can get them and then let the market sort out its next direction before I start taking significant overnight risk. All right, this is Kenneth Tortoise Capital. Keep your risk measured and your powder dry.